Hello everyone, thanks for checking out my video and happy Lunar New Year. We have witnessed a historical moment in the US stock market. S&P 500 ended last week by closing above the key 5,000 level for the first time ever in the history of the US stock market. The record-setting session came as investors cheered on the news of a downward revision to December's inflation data. An easing inflation data, solid earnings season, and a resilient economy. All these are forming a perfect Goldilocks scenario for both the Federal Reserve and investors. So, what could go wrong from here? Let's discuss this in this video. Also, I have some interesting statistics to share on what usually happens after S&P 500 close above a psychological level. So do watch on to find out more. The stock market rally had another solid week as it clinched a fifth straight weekly gain. What made the Wall Street bulls celebrated was that the S&P 500 has not once again created a new record high, but it did so by capturing the 5,000 level for the first time ever. What a historical moment. This push above 5,000 was likely due to a revision to December's inflation data. So what happened was that the US government adjusted the inflation number to 0.2%, down from the earlier reported 0.3%. To add on, throughout last week, corporate earnings were largely well received by investors, which have further lifted the stock market, with the usual AI and technology companies leading the charge. As a result of all this, the S&P 500 rose for the 14th week out of 15 on Friday. According to Dow Jones market data, the last time when S&P 500 recorded a similar stretch of weekly gains was back in March 1972. That's like more than 50 years ago. The index has risen almost 22% during this winning streak, the largest gain over such a stretch since August 2020. Very impressive. This week, all eyes will be on January's CPI data that is scheduled to be released on 13 February, Tuesday. This inflation data has generally been trending lower in recent months, but the progress of getting it down to Fed's target of 2% seems to have slowed down a little. This upcoming data point could be crucial in determining whether rate cut expectations will be pushed back further after Jerome Powell has effectively ended market expectations of a March rate cut. Right now, investors see a strong likelihood for a rate cut in May, but a slightly hotter than expected CPI number could further dampen market expectations again. Next up, investors will also be watching the retail sales data that will be out on 15 February, Thursday. This data could offer a glimpse into the consumer spending power in the US. But why does it matter? Well, durable consumer spending has been the key reason behind the current resilient US economy, despite a high interest environment. But here's the tricky part. A strong retail sales data could reignite fears of a rebound in inflation. Conversely, a weak number could create concerns that an economic downturn is around the corner. So in short, investors will want to see something in the middle, not too strong, not too weak. Wrapping up this week would be the latest consumer sentiment survey from the University of Michigan. This survey will tell us how consumers view their own personal finances and the broader economy. Again, why does this matter? To explain in simple terms, when consumers are optimistic, they spend more and stimulate the economy. On the other hand, if they feel pessimistic, they will likely cut their spendings. If spendings get cut drastically, we could see an economic slowdown or the worst case scenario, a recession. But that said, one should not use confidence as the only indicator of where the economy and consumer spending are heading. I would say the survey has its merit because it gives us a good gauge of the ground sentiment instead of just reading the news headlines, which a lot of times can be fabricated for certain personal agenda. Okay, moving over to the technical analysis segment, starting things off with the broader market represented by SPY. The market looks unstoppable as it printed 14 green candlesticks in the last 15 weeks as shown on the weekly chart. This type of parabolic winning streak is very rare and at the same time a little concerning. Why so? Well, let's dive deeper. The closest or the most similar parabolic run-up we had recently was from March 2023 to July 2023, where we saw 15 green candles out of 20 weeks across a period of 4 months. Prior to that, we had another parabolic run-up from March 2020 all the way to end December 2021. That was a total of about 21 months. And something worth highlighting is that on both occasions, the run-up was met with a big decline. The 2020 to 2021 run-up was followed by a 26% plunge as the stock market entered bear market the next year in 2022. And then, for the recent 2023 run-up, we saw a 10% correction between July and October 2023. Okay, I know the sample size is small, but if you are in the market long enough, you will know that parabolic moves are not sustainable. A significant pullback will always happen. It's just a matter of time. So for the current monster rally, it started in October 2023, and we are now in February 2024. That's about 4 months already. So the question now is, are we about to have a significant decline like last year? Or can it go further up, just like the 2020 to 2021 run-up which lasted 21 months? Well, nobody knows, but let's look for telltale signs. Let's now check out the daily chart. In terms of the upside, there are two main levels to watch, 501 and 510, because they are the 50 and 61.8 Fibonacci extension levels. These are the levels where the big boys or institutions usually take some profits. Therefore, I am expecting some form of buyer's exhaustion at either of these two levels. Okay, I know SPY is currently sitting at the first level already, so you may want to pay extra attention to Monday's movement. Well, it may stay above the 50% Fibonacci level with FOMO buyers stepping in due to the landmark 500 level, but overall, I am not too confident that SPY will take out the other 61.8 extension level at 510. If I am wrong and somehow SPY charges above 510, then I think the next resistance should be around 520. I mean, I can't even see it on this chart. Anyway, if SPY gets rejected at either of the resistance level this week, the first support of course would be the psychological level of 500. But honestly, if the big boys are taking profits, this 500 will mean nothing. In fact, we will have a high chance of heading towards the gap between 494 and 495, with the first support level coming in at only 493. Okay, any retracement, in my opinion, is actually insignificant as long as SPY stays above this green uptrend channel line. However, if we fall back into that uptrend channel and start kissing 480's range, then yes, we should pay a bit more attention. But actually, if you were to calculate, from the current price of 501 to 488, where the second Fibonacci retracement level is, it's only a 2.6% drop. I wouldn't call that a significant pullback either. Alright, moving over to Apple. In my last video, I specifically shared with viewers on how to spot whether the bullish momentum is continuing. Basically to see if we can get higher lows on Monday and Tuesday. And Apple did so. As a result, the stock was up slightly last week by around 1.6%. Okay, come this week, it will be a tricky week. Though Apple is no longer the biggest US company now, it is still a market-moving company as lots of institutions have heavy positions in Apple. So if the broader market wants to fall, Apple will likely fall with it. And why I said it's tricky because both the MACD and RSI are in no man's land. As you can see, MACD is rather flat, and RSI is in the middle zone of all time frames, namely 6 days, 14 days and 24 days. It's like the share price is waiting for a catalyst to happen. Anyway, Apple is very near a heavy resistance at around 190, where the all-important 61.8 Fibonacci level and the 50 moving average converge. A rejection at this area with solid volume will see Apple fall at least to 185. A stronger support will only come in at around 182 where the 200 moving average is. I have explained in my recent videos that Apple tend to bounce off this moving average, so I will not go into the details again. Below 200 moving average, we do have a last line of defense at around 179 to 180. This is a level where Apple somehow managed to bounce off on 3 occasions this year. If this level breaks, expect a waterfall. I would exit all my long call positions, if I have any. Alright, in terms of upside, if Apple can get above the heavy resistance of around 190, that's bullish. For full-blown bullish momentum, Apple needs to break above that blue dotted downtrend line. If we can go above that, there is a high chance for us to charge towards 196 and possibly 200 in weeks to come. Next up, let's talk about Tesla. In my last video, I was leaning towards the bullish camp for Tesla, where I shared that Tesla could go sideways and eventually grind up to 190's range. Look at where we are right now, 193, and Tesla was up about 3% last week. I hope that warrants a like button with both correct calls on Apple and Tesla. Anyway, before the bulls get all too excited, I would like to caution that we are not out of the woods yet. As you can see from the chart, Tesla did attempt to fill that huge gap that was created after it announced their disappointing earnings, but got rejected. So this week, watch this gap carefully. It's between 196 to 206, and coincidentally, 196 is the first Fibonacci level, and therefore this is the first resistance level to watch. But that said, my personal view is that this 196 level is not a strong resistance. A stronger resistance lies at 209, where the 38.2 Fibonacci level sits. So why is this a strong resistance level? Reason is because Tesla is trending downwards heavily. Therefore, if we have any retracement upwards against the main trend, it may not hit the 50 or 61.8 Fibonacci levels. Because a lot of times, a retracement in the heavily trended direction is shallow and not dipped, because the momentum is still on the heavily trended side, which in this case is bearish. Also, what didn't help is that the 209 level is near to the top of the gap, so market makers may push Tesla up to fill that gap, gets rejected at 209 and continue the falling trend. Alright, if you have learned something from this video or had found my content useful so far, I would really appreciate if you could support the channel by either tapping on the like and subscribe buttons or share the video with your friends. Or if it's within your financial means, buy me a super thanks or a cup of coffee via my Ko-Fi link, which can be found in the description box below. Meanwhile, I would like to thank the following viewers for your purchase of a super thanks and coffee. Really appreciate the support. Okay, on the other hand, it also means that if somehow Tesla can break above 209, it will be a very good news for the bulls. Just to add on, MACD just had a bullish cross below the 0 or baseline. Interestingly, the last 3 occasions when we had this, Tesla rallied at least 20%. So let's say we use 175 as the bottom, and the 20% rally will bring us to, guess where? 210. Isn't that where the heavy resistance level that I talked about earlier on? Okay, honestly, I don't know if Tesla will get rejected at 209, 210 level or not, but if Tesla is indeed pushing towards that area, from the current price point to 210, it's still a good 8.8% upside. Therefore, this 210 level could be a trading idea for Tesla, but I would also like to caveat that first, this is not a financial advice, and second, set a stop loss. For example, if 180 breaks, you will have to take your losses and move on. Alright, good luck. Moving over to Google. So in my previous video, I mentioned that if last Monday's intraday low doesn't fall below the previous Friday's low, the bullish momentum is continuing. And tada! Google went up more than 4.5% last week. Again, if you have benefited from my technical analysis, please hit the like button. Anyway, somehow Google has always been in a predictable trend and movement. If you are a long-term follower of this channel, you would have known that previously, Google has been moving in a consolidation range of around 127 to 139 for a good 6 months or so. Right now, since October 2023, Google has been moving within this green dotted uptrend channel. It is so disciplined. So if Google were to follow this trend, it means there is a high chance that it will slowly walk up towards the top end of the channel, filling the gap in the process. In fact, the gap down that was created during post-earnings was already more than half filled. and we are only left with 149 to 151. And just to share, the top end of the channel is currently at around 156 to 157. That's also where the 123.8 Fibonacci level sits. I know you can't really see it on the chart, but yeah, you can jot that down if you want to. On the downside, 147 should offer a decent support. In fact, that's the important 61.8 Fibonacci level that Google needed to go above to be bullish, and it did, with a solid green candle. But as the market has been overheated for the last 1 month, it is always good to be cautious. If somehow there is a sell-off in the market, bulls will want Google to still remain in this uptrend channel. A fall below this channel will almost certainly see Google headed towards the 130s range. Let's now cover my options trades. So in my last video, I shared that I am leaning towards bullish for Tesla, and I traded based on my own technical analysis by selling a cash secure put on Thursday, 8 February, which is a slightly bullish move. The strike price is 160, expiring on 22nd March, and I receive a premium of 168 for this trade. I mean, it's Lunar New Year, I just have to do it. For those who doesn't understand Chinese, the words are read as 一路发, which means get rich along the way. Okay, the thought process behind this trade was quite straightforward. I basically spotted 3 bullish signals. First, there was a bullish divergence on the RSI. Then this was followed by 3 consecutive candles of higher lows. And finally, there was a bullish MACD crossover. But of course, Tesla being Tesla, things could turn down south in 1 or 2 weeks. That is why I selected a strike price where the next support level is for a potential bounce. If you could recall, I did briefly mention that I don't see much support at 170s range. Below 180, support areas are in the 160s and 150s range. Ideally, I would prefer 150 as the strike price, but the premium was really low, and therefore I went with 160 instead, which is still not too bad. Next, I have 2 contracts that expired last Friday, 9 February. One is a covered call on Tesla with a strike price of 315. I mean, we all can see that Tesla did not even go close to a 300 level, let alone my strike price of 315. As such, my contract expired worthless. The next one is a cash secured put on Apple with a strike price of 175. At one point, Apple fell to 179, but it rebounded quite quickly, and therefore my strike price was never breached at all. Just like Tesla's contract, this contract also expired worthless. The total profit for these 2 trades are $392, less trading fees. Okay, for more information such as the rationale and thought process behind these 2 trades, you can check out my previous video. I have linked it at the top. Alright, as mentioned at the start of the video, easing inflation data, solid earnings season and a resilient economy have been driving the stock market rally since last year. And you add in more positive economic data and the AI boom, it's no surprise that S&P 500 has closed above the landmark 5,000 level. And a close above this psychological level is going to create even more positive headlines, sentiment, confidence, and FOMO for the stock market. Simply put it, we all know the market is overheated now, but nobody is selling. And if you are invested, you will be enjoying this monster rally. If you are not invested and belong to the FOMO group, you will be buying shares to chase this rally. Sellers simply get overwhelmed by buyers. According to the chief market strategist from Carson Group, in the 6 months after psychological levels are breached, the S&P 500 has never dipped lower. This positive sign was echoed by the chief technical strategist at LPL Financial, who shared that historically speaking, S&P 500 has been higher 1 year after crossing a major threshold. In fact, since 1968, the last 9 times the S&P 500 index reached a new milestone, it rose by 10.4% on average 12 months afterward. To add on, the S&P 500 was positive 78% of the time. There were only 2 times when the S&P 500 was not higher 1 year afterward, back in 1987 and 2014. To summarize, if history is of any indication, there is a high probability that the market is higher than the current level about 6 to 12 months from now. But there's always a but. Don't expect the stock market to keep going up in one straight line till the end of the year. Again, I have mentioned countless times that pullbacks are a matter of when, not if. I mean, the pullback could come in the next few weeks, before the stock market climbs higher in the next 6 to 12 months. Okay, that's just a wild guess, because really, nobody can accurately predict when is the next retracement and the extent of it. Just to share with viewers out there, apart from Tesla, I have not been picking up shares since the start of the year. So I am waiting for the next pullback to pick up more shares of the other companies that I currently own. But this method may not be suitable for many investors because you will run the risk of missing huge upsides. Therefore, for most long-term investors out there, dollar cost averaging is probably the way to go for you. On a separate note, while investors and the Federal Reserve are optimistic that inflation will continue to head lower over the next few months and that rate cut is imminent, the irony thing is that the resilience of the US economy can be a wild card. It basically can be a double-edged sword. This is because robust labor market, strong consumer spending and wage growth could turn the tide anytime and cause inflation to tick up again. And just so you know, if you were to pull out past records, the history has not been really kind to rate cuts. In short, the Fed usually cut rates because growth is slowing more than expected, or something in the system breaks. But as shared in my last video, there is no need to be too worried about any pullbacks at this point until key support level breaks. Because right now, it's the key resistance level such as the 5,000 mark that was broken. So just enjoy this bull run, stay with the trend until it bends. I will be covering that in my videos if the bull trend bends. Meanwhile, I am actually curious to know if anyone has picked up any shares of the big tech companies in recent months. Let me know in the comments section below. Alright, that's all for this video. Please like and subscribe if you found my content useful. Thank you.